Hi everyone, it's Grant Abbott speaking, and welcome to the launch of our unit trust documentation and also strategies. And hi to you, Mr. Ken Rees. Hopefully you got all those investment strategies out there for those wonderful property investors of yours and also Michael's. Welcome to the world of unit trusts. If we actually go back, unit trusts were really established way back in, probably really came to fame in the mid-70s with the use of managed funds. A lot of the initial managed funds were companies, and particularly in Australia, there was a problem utilising companies as managed funds investments, primarily because there'd be a double taxation of profits. This was pre-dividend imputation, which came about in 1985. So prior to that time, any profits which were distributed from the company were also taxed in the shareholders' hands. So that really looked at a position that, in fact, not only ordinarily just managed funds, but also a lot of businesses were set up as unit trusts, because at least that provided a flow through to the end beneficiary. The government got wind of that, introduced provisions in the Income Tax Assessment Act 1936, Division 6C, and a number of others to bring to account certain unit trusts as public trading trusts, so they'd be taxed as if they were a company. But we ended up with dividend imputation, and really we have a two-tier system now, whether we use a unit trust or whether we use a company. One of the benefits, of course, of using a unit trust is, unless it's running a business, that we still get that 50% tax CGT discount, which makes a huge difference. Now, if that discount dropped off the table, then we'd probably use a lot of companies. And I still think a lot of people do use companies now rather than necessarily unit trusts. But they've been around for a long time. I love them. They're quite detailed in their action, and really they're pretty hardcore. So when you're using a unit trust, it's not as if you're going to just run your own business through there. It means you've got a number of investors or a number of participants. We call them in our documentation initial unit holders. So they're primarily for business investment. Most of the ones I see are really for property development and syndication. And in the past, I've set up, since 1988 when I first came out. Came out, I didn't come out as, anyway, coming out from university, and more importantly, coming out of two Shross, I did lots and lots of syndications, and also set up huge amounts of managed funds using unit trusts. So I know them inside and out, and have been instrumental in doing billions of dollars through unit trusts. For most of our part, we'd be utilising them from a small point of view in terms of just looking after clients. But let's go through some of the key features and some of the different aspects for us. One of the things here, you're going to see this little meme, and hopefully I'll get more and more. From our perspective, we're growing our strategy and our strategy automation base more and more each day. We have, we're in fact light years ahead of anyone else in the industry. And when we're talking about the industry, we're not talking about SMSFs. We're talking about strategy automation compared to both the US and the UK, which is certainly a great feature, and want to make sure that we're further ahead of that. And you're going to see that for those of you coming to the October Roadshow. But at the end of the day, your success is our success. We know there's a lot of document providers out there, but just do boring old documents without having the underlying strategy just doesn't make sense. So for us, we're basically a strategy engine, not a document engine. Everything has got inbuilt strategy in it. For that, when we have a look at it, we've got, for us, we've got 4 different unit trust entities. Each has got a specific purpose. And I think that's instrumental compared to anyone else. Each one has its own strategic purpose. And look, I'm more than happy for you. In fact, we've got a number of our LIghtYear Docs users will say, look, Grant, this is what I'm doing. And you can send me an email to Grant at ilovesmsf untitled.com, or simply raise a ticket or get on the chat and raise an issue on the LIghtYear Docs site. Just say, look, this is what we're looking at doing. I want to do this, this, and this. Which is the best unit trust, or should I use a company for that purpose? Because again, I know the ins and outs of all the documents that we've built. So I know the purpose it is for. It's very hard to relay that purpose on the site. We will get, obviously we've got a lot more videos there, but if you're sitting there with a client issue and you're thinking, bang, what do I use? Come through to us and we're more than happy to cover with that. Even if you are a LIghtYear Docs user, particularly if you're the LY strategist or LY firm, so using Unlimited, or you're one of our lucky licensees, feel free to just contact me and let's do a good half-hour, 45-minute walk around the site, so you can see what my favourite strategies are, etc. So please, just again contact me, and I've got a couple of booked today. So you'll really, once you get into it, you'll actually understand the power of the platform that we've built. Now, with the unit trust here, so this is what we're looking at the moment, which is our stock standard unit trust. It's an all-purpose unit trust. It can be used to run a business, develop property, can be used for investment purposes. So, for example, you could trade CFDs or cryptos or do whatever you want in there. And of course, you can do property syndication. Look, I've done a number of really interesting ones where we've had unit trusts, we call them development trusts, where unit holders, initial unit holders, put in monies into that unit trust. They then secure the services of a developer who'll then come in and develop the property in there. They'll do some borrowings. The developer takes a fee, or a builder takes a fee, and then the development profit is left within the unit trust. But what happens from there is that the unit holders can then get a distribution, a capital distribution, which would obviously roll up with their distribution, or their development profit distribution, and they take that by way of an in-specie transfer of property outside. So I've done a number of those, and really there's a lot of flexible stuff you can do with unit trusts, particularly property investment, so on and so forth. Our unit trust, and I'll cover a bit later on, is more of a hybrid, so you've got flexibility as to what characteristics of income you can distribute. The fixed unit trust, which I won't have time to go into today, but that'll be up early tomorrow. The unit trust is already up. The fixed unit trust will be up tomorrow. It's pretty limited in its use, and I'll go through why it's different to the unit trust. But prima facie, it's really, the benefit of it is for New South Wales land tax purposes. It would have really come into its own if you remember the last election, that the Labor Party was going to obviously tax all unit or all trusts that were not fixed trusts at a flat rate of 30% for any beneficiary. So this would have really taken off, which is why we built it. But now it's there for those people in New South Wales there. So again, I'll go into the differences a little bit later on. Now, we've already covered this, and you can find this in the support centre. This is a superannuation unrelated investment trust, which is primarily the same as the all-purpose unit trust. And again, it's for unrelated parties, but we've given a good, strong overlay so that we can have a number of initial unit holders being SMSFs. And I've just put a lot of protection mechanisms around that from an SMSF perspective, as opposed to the stock standard unit trust. So if you're going to have SMSFs investing in this, you can still do all of this stuff in the unrelated investment trust. But I would, from a professional perspective, use the SMSF. Again, you've just got to make sure that no SMSF or group, which covers the SMSF, it covers also a related trust, it covers discretionary trusts and relatives, etc., all grouped, as long as no one has more than 50% of ownership of that unrelated investment trust. Otherwise, it ends up being an in-house asset. And that's the same, obviously, with the unit trust. But what we've got is, this is a really tight subset of this unit trust. And this one here is even a tighter version of that unit trust. So we've got all the same bare bones, but a 1322C trust is a related trust, where a SMSF and its group of entities such as family trust, etc. You saw my presentation on this or webinar going back a few weeks ago. Can effectively hold all of the units there. And if it's a family trust, we can actually transfer those units over to the SMSF by way of a contribution. So I really love this one, but it is limited because you can't have any borrowing or interest in other shares, etc. So it's good if you're just doing resi property, and it's really basic about just transferring it over, or even artwork. But it's a very limited subset. Still like it. It has got a lot of flexibility. If you want to know more about it, go and have a look at obviously that webinar that I did. So we're going to look at the unit trust today. Fixed unit trust we'll have a look at. I've already done 1 hour sessions on both of these, so make sure you have a look at that. So the all-purpose unit trust, just a couple of things. It is a managed investment scheme or a managed investment trust for the purposes of the Corporations Act. Now, if we have, so there's a couple of things there, is that if we're recommending, if we're a licensed advisor and we're recommending to our clients to invest in this unit trust, then we need to be licensed to do so. If you're licensed with a dealer group, just make sure that it's on your approved product list, which is probably not the case. Generally, though, is we may well want to limit it to no more than 20 unit holders. If we keep it within 20 unit holders, then we don't need to have a product disclosure statement. So there's exemptions in the Corporations Act for that. But generally, the way I see it is that clients will come to us and they'll say, well, we want to do a development. And so you parcel up a few of the clients there. And then the trustee of that unit trust will then go and recommend to other people or spruik that property, as long as we don't go above those 20 unit holders. So just be careful of that. Also, another one for us is you've just got to be really careful if you set one up for a client, which is A-OK, and you're involved in it. Just be careful if you go down and do another one and you're involved with it. And when I mean involved, you're actually an initial unit holder, or you're a director, or you're part of the trusteeship. If you go down the track of doing one, so this is for a client, then they do another one and another one after that, you end up being a promoter. And as a consequence of that, you need to be licensed. So watch out for clients who've done 2 or 3. They may well end up falling foul of that and being classified as promoters. Look, I don't really need to go through. Tax is a standard trust with flow-through distributions of income. Prior to 2016, if there was 20% interest of a SMSF, then and it wasn't really just eligible investment income, so they're running a business or development, it would be taxed as a public trading trust and taxed as a company. But they had the temerity to change that in 2016. So if it's a public trading trust and it's a public trust, then effectively it's going to be taxed as a company. But just be wary of that one. And if you've got any issues, please contact us or Tony Anamoulis from our legal firm, which is about to change the name from TGA Legal to Abbott-Morley. That's a nice name, isn't it? To Abbott-Morley. Contact him because he's a bit of a whiz on that tax side. If it's in the business of property development, so one of the things we said there is that obviously we love the CGT, but if you're in a business of property development, then it's just going to be taxed as ordinary income. So your profit will just be income, and that will then flow through to your beneficiaries, and there won't be a CGT event at that stage. You can have borrowings. If you want to do borrowings, the deed's going to obviously need to go through to the bank. And look, I'm happy with where our deed is. A fixed trust, though, is, as I said, that it's got the same as we had a look before. So it's exactly the same page as we had there. By the way, all of these slides will be available for you when we put them up on the site, and I'll show you where they are a little bit later on. But it's the same as the all-purpose unit trust. But essentially, it's there's an exemption there. Under New South Wales Land Tax, we tend to group all entities that are part of it. But if it's a fixed trust, then it's not part of the group. So the key conditions for it, and you can get this straight off the site, the unit holders are presently entitled to all the income of the trust after payment of the proper expenses incurred by the trustee in authorised administration of the trust. The unit holders are presently entitled to the capital of the trust and may require the trustee to wind up the trust and distribute the trust property or the net proceeds of the trust. These entitlements cannot be removed, restricted, or otherwise affected by the exercise of any discretion or by failure to exercise any discretion conferred on a person by the trustee, such as an appointor, etc. And for unit trusts, only one class of units can be issued, and the proportion of trust capital a unit holder is entitled to on winding up or surrender units must be fixed and must be the same as the proportion of income of the trust to which the unit holder is entitled. So really it's, look, it's like a lockdown version, a concrete version. If we compare to here, for example, and I go back to all-purpose unit trust, or alternatively superannuation unrelated investment trust, then when we have a look at these vehicles, all-purpose unit trust or superannuation unrelated, we generally may want to have different classes of units. So, for example, you might want to have a capital unit versus an income unit. You say, well, why would I want to do that? Well, with the income unit is primed for the accumulation side, for the pension side of the fund, because it's providing cash flow, the income, whereas the capital unit is primed for the accumulation side. So it increases the accumulation. So again, different classes are perfect for our superannuation unrelated investment trust and also our all-purpose unit trust there. If we then go and have a look, our fixed unit trust, as I said, you can't do that. You can only have one class. So this is, hopefully this is, if Labor gets in, hopefully this is not going to be the generalities, because if it does, it means essentially we're just going to move to utilisation of companies. A final one before I actually go in and show you how to build one is a unit holders agreement. Generally, when you've got property development or properties, or you've got businesses, like a partnership or a company, wherever there's entrepreneurial risk, there's a chance that things will go wrong, particularly in property developments. I've been around property development since 1988, so it's a good 30 years now, and I've seen so many go wrong, but then again, I've seen a lot go really well. So the main thing there is that if you've got all the initial unit holders, we need to put in place some parameters around that. Now, what I've got here is you'll find that in the underlying unit trust, and if you're on the unlimited or you need a sample, please contact us at support@lightyeardocs.com.au, and we can give you a review of the unit trust. But essentially, we've got to make sure that the company's established as a trustee. Directors are chosen for non-control, but the deed itself, once you go in, you're going to find that it really covers a lot of the issues that would be found in a unit holders agreement ordinarily. So that it covers things such as what happens on the death of a major unit holder, the pricing of the units, transferring of units by making sure there's an offer to other unit holders first, and also covers disputes. However, the issue that we need to have a look at, particularly for property developer investors, is we need to put a time limit on the transfers, tag and drag, so that if 75% of unit holders agree to sell, then everyone has to move along down that track and they can't raise an action. So, and then if it's a business side, it's, well, what happens on divorce, what happens on dementia. So there's a whole range of other elements that would ordinarily be part of what we call a unit holders agreement, which is a separate contract that becomes part of the trustee and manages the affairs of the unit holders vis-a-vis that unit trust. So we will be putting up a basic unit holders agreement up on the site. Not yet. Probably our big focus at the moment is our estate planning suite, which we're currently working on, and that will be released at our October Roadshow in a couple of weeks. So that's got all our attention, but certainly in December, I'll be doing a unit holders agreement. However, if it's a big ticket item or a big project or millions tied up, then it's probably worthwhile for your own perspective is to take the risk off the table and get us to quote to actually do a Abbott-Family, the legal firm, to actually get a unit holders agreement for you there. So that's probably the best bet there. Now let's move out of here and let's just jump onto the site proper. I saw you, Scott Kay. Thank you for attending. Scott asked me a question the other day, and hopefully he doesn't mind me going through it. But essentially, this is the LIghtYear Docs site. Essentially, under New South Wales, Queensland, virtually every state, if there is a foreign owner of land and they acquire land, there's a surcharge of up to 7 to 8% of stamp duty. So when we're looking through setting up discretionary trusts, etc., we need to protect ourselves there to ensure that we don't get pinged for that foreign stamp duty. But Scott, if you want to give me a call on that, I've built one, and the only problem I'm having is where we've got I know you're looking at the leading member discretionary trust, is whether I put that into all of them, or should I just have special purpose vehicles for that, much the same as we have a special purpose for our QROPS SMSFD, which will be up and running very shortly. Again, you can see from this is we're a caring and sharing community, that if you guys see a need for a particular document, more importantly to go and have a look at it, do our research, build it, and then really make sure that it fits your needs. So if we just go through, again, if you want to register for next week's webinar, do that. We've had a number of registrations coming through here, which is great. So we've got all our documents that are coming in. One of the ones that I would just raise for you is our support centre. I go through this all the time, but there's a lot of client documents there, webinars and how-to videos. So make sure that if you're looking at anything, so for example, related party loan on a property to an SMSF, honestly, that takes you 5 minutes to do on our platform. So you can go and try it, but why not look at the document training video? LRBAs and holding trust for bank and non-bank purposes. You know, we've got SMSF investment strategies, deed of gifts. You can see all the sessions that we've done, and this is going to be built up over time. Commercial leases, leading member suite, which is great. You know, installment warrants, our whole loan suite release. There's that superannuation unrelated investment trust. So, you know, if you want to go and do that, have a look at that, and then there's a whole webinar there for you. So please feel free to utilise that because that'll just make it a lot easier finding a way around. And also, it's not a bad idea to actually do some staff training on that. Sit down and work through all of those sort of ones there. I've got a couple of questions there. So I've got Ken Race. Is there any loss of asset protection re units in a fixed unit trust if unit holders have the fixed rights and can demand, say, a redemption? Potentially, that's a really good question, Ken. I would say that if you have got a fixed unit trust and you can demand a redemption, then as opposed to a hybrid or discretionary trust, your trustee in bankruptcy will definitely, unless you've got a liquidator in a company, is definitely going to have a look at that because you've got the right of redemption. So I probably again use the ordinary unit trust rather than the fixed unit trust. Again, it swings and roundabouts because at the end we've got a scenario whereby the fixed unit trust is prime for our obviously land tax. And so if we want to give that up, then we might if we give that up for asset protection, then obviously we have to pay land tax. Scott, thanks for sharing. My opinion is separate dockers don't want to disallow foreign beneficiaries. Okay, so I'll take that on, Scott, and what I'll do is I will work on that today and have something there for you tomorrow on foreign beneficiaries. So I've already got the document. I just didn't know whether to build it together, but I think it probably is a better idea to actually have a separate suite for foreign beneficiaries anyway. Let's move on and have a look. So that's a support centre. Again, you've got enduring powers of attorney. Well, there's so much there. So please continue to use that. Alternatively, if you need to contact us, just do a support. So just say, look, I need, I've got this issue. what's the best document for us, and that then comes through to my phone or goes to our support team, and then we're happy to answer that. So for the unit trust, I can simply go in. I like using the Google style search engine. I'll just go unit trust, and there I've got a CIS and a standard non-fixed unit trust. Alternatively, it will actually be sitting down in, here in the trust. So I go into the category there. I've got my discretionary trust, my non-fixed unit trust, which I've got there, change of trustee, discretionary trust distribution minutes, 1322C, superannuation unrelated investment trust. So let's just go through the unit trust here, and I'll start the document. I'll go into my folder again, so I'll just go the Abbott-Family. For those who've seen before, if I tried to start that, it's not going to go anywhere. So because I need to actually have a green, so I'll just go like that, and see how the green has popped up at that stage. So I'll go through that and cover that. I think I've got someone else on the line who happens to be unfortunately, that's my partner who's on the line and had it on mute. So I've got, I'll go through here. So this is my standard. For those of you who have seen me type before, I'm pretty hopeless. So I'll go through. One tip, as you go through, always save the answers. That way you don't lose anything on the way through, particularly if you leave it too long. So I'm going to go into my vault, and you can see there I'm going down to the Abbott-Family again, and then what we'll do from that perspective, what we'll do is we'll go through and have a look at the Abbott-Family and all the documents, and you can see there with the documents right down the bottom there, the non-fixed trust. So I did this earlier. I did a lot of these ones previously in prior meetings. I press that little plus button. You can see there I built that this morning. And I've got 3 buttons. I can either download it, I can trash it, or I can relaunch. So you can go back, if you've got changes to details, you can go back and relaunch. So this is the one I did this morning. Let's go through. So I've got the Sandman. I'll just blow it up so you can probably see it. Oh, I can't do that, so you can see it there. So it's a Sandman Property Trust. It's New South Wales. I don't know the date it's going to be executed, so I've left that blank. I then go to the next. So who are the initial unit holders? So we've got 4 there. We can go an individual, company, trust, SMSF. Look, if you ever come across a partnership, then please, feel free to make sure that you put the partnership there, and what we can do from that perspective would be fine. So when we have a look at that, we'll just go through. I've got an individual, the first one, 50,000 units, $50,000 being the initial amount, and 50,000 units. We've got the name of the person, we've got the address, and then we've also got the obviously suburb, etc. We go then to the next page. We've got another initial holder. I'll put in a company here. This has got 100,000 units. So this is Smith Property Development. So this may well be the developer who's involved in the process. So this is going to be pretty stock standard in there, and they take some of their profits out of there. Now they have a building contract as well. We've got sole director there. So John's obviously is obviously a developer as well. And then I've got a trust, and then again the trust 100,000. Now we've got an independent party, the Jordan Family Trust. And again, we've got an individual who's the trustee, or we could have a company. And so we've got John Jordan as the trustee. So it's just one individual, but I can always add others if I want. So they're our initial unit holders, which are really crucial. So we've got family trust, company, and also the individual. We then go through, and now we've got to build the trustee. As I said before, where you've got independent parties, it's certainly preferred to make sure that we have a corporate trustee, and then you've just got to watch out for the control of the process. So here I've set up Sandman nominees, and you can do that again, is you just do that through our website. Set up a corporate trustee, you've got the street line address, directors. I've put in 3 there. So I've got John Jordan, who's the other thing, and Janet Price, who's an independent person. Now, these are the initial unit holders, obviously. Now that's the end, so we go to production. So these are the initial unit holders. Now, you can bring other unit holders. Remember, I said you can go up to 20, and there's a process for that in the document. At this stage, we're just building all the trust registers and all that, and I'll talk about that a little bit later on. But I've downloaded the document. Can you see that? It comes up in a PDF. Now, mind you, I can change it at any point in time, because all I have to do is, if I've got a problem, I don't want to call it Sandman anymore. I just go into here. I've got my non-unit trust, my standard fixed trust, and then you can see here, I could relaunch it again. So I'll go through that process, and I could say, well, hold on, people aren't really keen on the old Sandman. So I can just simply go through and change it to the Sandpiper property trust if I wanted to do that. Save that answer. Then I just have to, if I want to go through, I then just go through to the finish, and then it will pop up. So it's just being processed. And then I download that. You can see that pops up there. And bingo, I've got the Sandpiper Property Trust. So that's how easy it is to change. At this stage, we will be introducing a little bit later on a different version of the system where you can put your own logo up here. But if you want to put your own logo, it's not going to impact, because again, it's still signed off by TGA Legal, or it will be Abbott-Family. So what you can do is just, if you've got a document like Nitro or Adobe, you can just transfer your own. You can transfer your own logo there if you want. So we've got the Sandpiper Property Trust. We go in and we've got obviously our disclaimers there. Unit trust deed. The initial unit holder is John Smith. John Smith is director of the Smith Property Development. That's the company. And John Jordan of 100 Collingwood Street, Collingwood, as trustee for the Jordan Family Trust. And then we've got the trustees, John Jordan, Janet, as directors of the nominee company. So that's all fine. We've got the rest of the details. Initial unit holders pay the initial amount to, and when they say, we don't go unit holders, because in the definitions interpretation, singular means plural. So the initial unit holders pay the initial amount to the trustee to establish a trust on the terms of this deed. The trustee has agreed to act as trustee of the trust and hold all monies and investments on the trust as set out. The provisions of this deed apply to bind the unit holders also to benefit them. The unit holders may include trustees of self-managed super fund or related parties. So again, you can use that, but again, my preference is that, look, if you are going to really do an SMSF, go and have a look at the video that I did, and I'd be using a superannuation unrelated investment trust for that. So go through and have a look at the difference. But again, please feel free to give me a call. So we've got that. We've got the Sandpiper Property Trust. We've got the initial amount, which is our total initial contributions at 250. Now, as I said before, we can have a position whereby we add additional unit holders as we go down the track. Now, I've still put all SMSF and a lot of stuff in the suit that's in there. We then go down, and I won't go through the deed. Feel free to go through a sample. Governing law is New South Wales, Sandpiper Trust. And then here we go, we've got the various unit holders. So this is like the initial unit trust register, which we will be putting on a little bit later on. So we've got the beneficial interest, who actually holds it, no entitlement to any part of the trust fund, additional units. So subject to restrictions or conditions on the issue of additional units and provisions as to the issue is set out in the deed, the trustee may create and issue additional units at an issue price, and such persons as a trustee by resolution may determine. The issue price received on issue unit becomes part of the trust fund. And again, all new unit holders are bound by the deed. You have different classes, have an application form if you want to do, restriction on the issue of the units. So that's pretty important. How you go through, register of unit holders, which we will be looking at, your certificates, which are going to be part of it, how to redeem the units, and that's at the request of the unit holder, or the trustee can actually redeem again. And then we go into calculation of the unit price if there is a redemption, and who it goes to first. On redemption of the unit, how it goes through, payment of the unit price. So, there's a lot of stuff on there. Transfer, form of transfers, and has to go to all other unit holders beforehand, issue of new certificate, transmission of units on the death of the unit holder. As I said, if you've got dementia or divorce, what we do is we'd actually cover that in a separate unit holders agreement, which Abbott-Family can do for that one. So we've got all of that sort of stuff, which is good. And then income and capital. So the trustee may determine which is capital or income. And again, remember I said it's a good idea to go back to the old school and have different units, one a capital unit, one's an income unit, but it gives a discretion as the trustee how to do that. Accumulate income if you want to do that. Distribution of income to unit holders, application of capital. There's a lot in there, and you can have also different income and capital amounts, so you can actually have a lot more discretion there. So it's a pretty robust unit trustee there, but more than happy if you want to have a look at a sample. For those of you who are on Unlimited, just simply go and play with one and have a look at what's basically sitting in there. So for our perspective, when we have a look at this, we're in a pretty good position for all of this, is to go and get a scenario. You've got the unit trustee. The fixed unit trust will be up tomorrow from that perspective. From our scenario, what we'll do is let's go back to the unit holders agreement. As I said before, it's not a bad idea. Just to finish off, again, we've got a whole suite there. Make sure you come to the October roadshow. I've seen a whole lot of roadshows. We probably didn't pick it the best time, because I know Self-Managed Super's got one. I know SMSF Advisors got one. I know Bronny Speed's got one. So apologies for that. But look, honestly, if you have to go to one for the year, you want to go to this one, because I will be going through all the strategies that are sitting on our platform, going through how they fit, when they fit, how you're going to build that. So it's going to be the first time you're actually going to have a full strategy suite, and not only with that, but also client communication as well, and plus suggested pricings for each of the strategies. And you're not going to get that anywhere else. Look, you go and listen to talking heads that talk about strategies. Here, you're actually going to be able to do it. And for those who come along, I'll be putting credit on your account for the day, so you'll be building the strategies along with me. We're going to be looking at parent contributions. That's an absolute must. The Supermax contribution, which I love, running family protective trusts for bloodline and lineage, both in trust and SMSFs under what we call our leading member umbrella. We've got estate planning, you got wills and testamentary and super proceeds trust, which I've built, and we're going to do that. We've already got our EPOAs. We've got lots of case studies, and really I'll also be introducing my new living will, which is a set of binding directions for people who are mentally incapacitated that binds the trustee. So I built that over the last couple of weeks. I was just going through the legal process with Tony, so you'll actually get to see that. So make sure you come along. Also register for next week. Next week at this session, I'm going to be looking at change of appointor for trusts. So we now need to build in succession in that, maintaining a trust register, and also a declaration of trust where property or assets are acquired as a nominee. So I've got here from Sebastian. Good to see you, Sebastian. Grant, just wanted to check if unrelated parties purchase real property via unit trust, they need to stay under the 50% control test. If the units in the unit trust were held in part by a related person entity, one SMSF, can they be transferred to the SMSF? So we've got two things there. Is to be if we want to get outside the in-house assets test, then we have to look at control. So once we go over that 50% level of the control test, then it doesn't matter what the underlying. Well, it does in one instance. If we go above the 50% test, it now becomes a related trust, Sebastian. So what it would be there is it would be an in-house asset. The exception to the rule is that effectively, can we make that unit trust if I go back here, a 1322C trust, because business real property is excluded as one of the exemptions under the 1322C trust. But we've got to get rid of our borrowing in that trust, if that's the case. If we go above it, then we're caught unless we can go to 1322C. Now, if we are a superannuation unrelated trust, and again, it can be unit trust or the suit, which is my preferred, we can't transfer units from a related party into an SMSF unless it's classified as an in-house asset, which we generally don't want to do. Although you can transfer up to 5%, so you can acquire 5%. There's a bit of a loophole there. Whereas if you've seen the webinar on SIS Regulation 1322C, for that, you can actually transfer as many units as you want. So it may be worthwhile that you could keep it as unrelated parties until you pay down the borrowings, and then you turn it from a unit trust into a 1322C trust from that one. But again, that's a really good question. Anyway, if there's, I think I've got one more chat. Ken Race, we'll be looking at a no vesting date testamentary trust. Yes, so that will be, I'll be looking at the no vesting date testamentary trust and superannuation proceeds trust. Another one that I've built is a SMSF testamentary trust, which is essentially a discretionary trust, which is built out of a set of binding death benefit directions from the SMSF. So it doesn't go into the estate. It actually is created on the death of a member. So again, if you're really into estate planning, make sure you come along to that session. But again, look, please feel free to give me a call. I've got a few things to do. The fixed unit trust for Scott, I've got to do a discretionary trust that has separate for foreign beneficiaries, and then we're off and running. But again, thank you very much for coming. I'll have this up on I'll send this out with the slides this afternoon, but this will basically come up on the support centre. Anyway, thank you very much for your time, and we will see you at the roadshow. If you haven't booked your tickets, make sure you do, and also bring along your staff and also your referral sources like your accountants and planners. You'll blow them away. Anyway, it's Grant Abbott signing off.